I actually have many, but maybe I would focus on one professional, one personal. Professionally, I'm going to be focusing a lot more on individual bottom-up credit analysis, both of corporates and sovereigns, because this will likely be the year that quantitative easing stops, if not reverses, and also that the interest rate cycle will reverse. On that standpoint, I would say that the winners are going to be the countries that have done the best job of fiscal consolidation, either in reducing their quite high levels of public debt, or alternatively have kept their budget deficits quite low or achieved surpluses. And here I might point to two countries, including Serbia and Croatia. On the negative side, some countries such as Poland have been a little bit less constructive about keeping their deficits low, and I might say the same about Hungary. Hungary had the opportunity of a surplus, but in order to support growth, they've decided to spend it, so their deficits will be close to the EU ceiling. That will support growth, but at the cost of less fiscal consolidation, and I think the investors won't be quite as pleased with that. From that standpoint, I conversely am not as concerned about the economic impact of populism. And in fact, if we look at countries where it's most discussed, Poland, Hungary, and Romania, in Poland and Hungary, I think there's a lot more political bark than bite. And on a sectoral basis, it can hurt in a country such as Poland, but there the growth momentum still seems quite strong. But if there is an impact, I think it's more likely to lead towards overheating. And if there is an impact on growth, it will be a year or two from now, maybe even 3 years from now. And there I would point to Romania being most at risk. I think the best opportunities are in countries still on the frontier. As I mentioned, countries such as Serbia and Croatia, but also possibly countries such as Montenegro, Macedonia, and Armenia, which have been less picked over in the past, albeit at the cost maybe of some market liquidity. Aside from geopolitics across the board and the impact that might have on market sentiment in individual countries, I think the biggest risk by far is what happens when the interest rate cycle turns around. For the time being, we've had a very strong start to the year, a very positive first 2 weeks, but I think that's been pulled a lot by the continued rise in global equity markets. But we can't have both a surge of flows into equity markets at the same time that interest rates turn. They've already turned in 2 European countries and probably will turn in a lot more fairly soon. I think we'll be talking a lot about the ramifications of the end of the ECB policy. We'll have had a lot of elections during 2018. We'll be looking forward to more in 2019, but I think we'll also be congratulating the economies on the continued improvement in economic growth, better balance in the economies, and continued strength in their balance of payments. So I think it'll be another constructive year, just like it seems to be regarding sentiment.